Welcome to vTalkInsight Allocator's Lens Daily for February 5th, 2026. Cross-asset signals are flashing mixed today. Equities are undergoing a violent rotation around artificial intelligence. Credit markets are priced for calm, and hard assets are waking up again as volatility and policy uncertainty rise. Let us start with equities, where dispersion rather than direction is now driving the story for portfolios. Equity markets look far more eventful under the surface than they do at the index level, with factor rotations and artificial intelligence narratives reshaping risk across regions and sectors. European equities are a clear bright spot, with a broad Stoxx 600 index pushing toward record territory, signaling solid regional risk appetite. That optimism is anchored by expectations of sizable policy support, including talk of major fiscal stimulus in Germany, potential rate cuts, deregulation, and a pipeline of high-profile initial public offerings that together could underpin earnings and liquidity even if volatility remains elevated. In contrast, recent declines in the main U.S. benchmark and a rise in the volatility index into the high teens underline that investors are now demanding more compensation for equity risk as leadership changes and policy questions build. In the United States, leadership is rotating away from crowded momentum trades toward quality and value, which has important implications for portfolio construction. Momentum-oriented exchange-traded funds have seen sharp drawdowns, while investors increasingly favor cash-rich, fundamentally solid companies and traditional value sectors such as industrials, transports, staples, utilities, and energy. Energy in particular stands out, with energy stocks reported up around 17% year-to-date and the Russell 1000 Value Index outperforming, indicating a reversal of the narrow, mega-cap tech dominance that characterized earlier phases of the cycle. Smaller companies are also participating, with the Russell 2000 up nearly 7% since the start of the year, suggesting that segments less exposed to direct AI disruption and more sensitive to Federal Reserve policy expectations are catching a bid. At the same time, the AI infrastructure story remains powerful, but is increasingly constrained by valuation and capital intensity. Alphabet has just delivered robust results, with revenue growing 19% and earnings per share beating expectations, and its cloud business expanding at roughly mid-40s rates, reinforcing its status as a vertically integrated technology platform. However, the company is guiding to extremely heavy capital expenditure, with this year's budget already far above prior consensus and total spending projected as high as the high $100 billion range by 2026, contributing to a valuation near 31 times earnings and raising questions about how quickly shareholders will see a payoff. The broader AI hardware ecosystem looks similar. NVIDIA is reportedly weighing a $20 billion commitment to OpenAI. AMD is seeing accelerating demand for CPUs and GPUs as AI workloads ramp, and server maker Supermicro has surged on a strong outlook, while Infineon plans to double AI-related power revenues over the next couple of years. Overall, the physical infrastructure side of AI chips, data centers, power, and networking is where growth visibility appears strongest, even as valuations in some flagship names already discount a long runway of success. The flip side of that enthusiasm is acute stress in software and some high-valuation tech, where markets are struggling to separate likely winners from potential casualties of AI disruption. A new automation tool launch has triggered broad-based, sometimes double-digit daily declines across software, financial services, and private capital names, erasing an estimated $2 trillion from a key software index and leaving the group in about a 30% drawdown despite roughly 10% upgrades to earnings estimates in September. Multiples have compressed by roughly a third, yet many companies still trade at very elevated earnings multiples, with some above 100 times, suggesting that the margin of safety remains thin where business models look vulnerable to AI. That said, not all software is equal. Core enterprise platforms with deep integration and mission-critical data, such as large workflow and database providers, are seen as better positioned, and historical episodes of automation often expanded end markets rather than shrinking them. For allocators, the key equity questions now are how far this rotation from expensive growth and momentum into quality and value can run, whether AI infrastructure spending continues at today's aggressive pace, and how much of the software sell-off proves cyclical rather than structural as more real-world AI use cases roll out. Turning to interest rates, surface-level calm and yields masked some important policy cross-currents that could matter later this year. On one side, the administration is encouraging Fannie Mae and Freddie Mac to expand their purchases of agency mortgage-backed securities, with as much as $200 billion of additional capacity under existing caps, explicitly aiming to support mortgage spreads and lower borrowing costs. On the other side, the Federal Reserve is still allowing its own mortgage holdings to run off as part of quantitative tightening, highlighting a tension between fiscal and housing objectives and the central bank's desire to shrink its balance sheet. Commentators note that a gradual, well-telegraphed reduction in the Fed's portfolio would likely be digested smoothly, whereas abrupt shifts could quickly flip broader sentiment back toward risk-off and reignite volatility. Complicating the picture is uncertainty around Federal Reserve leadership and communication strategy. Historical patterns suggest that changes at the top of the Fed have been associated with market drawdowns in the mid-single to mid-teens range over periods of 1 to 6 months, regardless of whether the new chair ultimately proved hawkish or dovish, underscoring the importance of perceived policy stability. There is also concern that the central bank could shift away from its current, highly data-dependent approach toward a more opaque, forward-looking framework, which would force investors to infer intentions and could raise rate volatility. Yet despite these risks, implied volatility in the bond market has fallen sharply, pointing either to confidence that macro dynamics will stay on track or to a degree of complacency that leaves little buffer if inflation, growth, or policy expectations surprise. Credit markets are sending an even more tranquil signal than rates, especially in Europe, where spreads appear to be pricing in a very benign outlook. Euro investment-grade spreads have tightened to roughly 72 basis points, the narrowest level since before the global financial crisis, supported by strong inflows and a robust search for carry. Against that backdrop, demand for securitized products is outpacing interest in sovereigns and plain vanilla corporates, as managers look for incremental yield and relative value opportunities despite already compressed risk premia. This combination of very tight spreads and persistent demand suggests that public credit is vulnerable to any negative growth or policy surprise, even if near-term default expectations remain contained at the index level. Beneath the aggregate calm, the banking sector offers a more nuanced picture of credit risk. Some European lenders have reported weaker profits tied to restructuring and have increased loan loss provisions, including for one-off items such as consumer litigation and small bank support, which has raised questions about profitability and asset quality in specific segments. At the same time, management teams emphasize that underlying cost of risk remains stable, coverage ratios are high by regional standards, and they are closely monitoring exposures in areas like consumer finance, construction, and small corporates without yet seeing a broad-based deterioration. For allocators, that mix reinforces the idea that bank credit stories are diverging and that the evolution of provisioning, rather than headline earnings alone, may be the key metric to watch. The most acute credit concerns today are linked to the same software and technology stress showing up in equities. Banks have reportedly struggled to syndicate over $1 billion of loans tied to software borrowers, and analysts warn that if AI disruption intensifies, default rates in private credit exposures to the sector could climb into the low teens, especially where leverage is high and cash flows are not yet proven. Private capital that previously provided a valuation and financing floor for software is now seen as overexposed and less willing or able to add risk, increasing the downside for both equity and debt instruments in weaker franchises. Separately, the ongoing debate over whether intermediaries should be allowed to pay interest on stablecoins highlights a potential fault line between crypto markets and traditional bank funding, with policymakers weighing the risks of deposit flight and financial stability as digital assets evolve. Foreign exchange markets are grappling with competing narratives around the U.S. dollar and broader currency allocation. One camp expects the dollar to appreciate gradually through 2026 as risk premia normalize, political risks ease, and pro-business policies such as deregulation and corporate tax cuts continue to support capital returns. Another view, highlighted by some large asset managers, anticipates ongoing dollar weakness if current U.S. economic policies remain unchanged, and is already reducing U.S. exposure and shifting new flows away from the greenback as part of a broader de-dollarization trend. What is clear is that, for now, the dollar remains strong relative to many peers, even as investors diversify incremental income into a wider set of regions rather than exiting U.S. assets outright. Within that framework, preferences are emerging across major and emerging currencies. High-yielding units, such as the Australian and New Zealand dollars and Brazil's real, are currently favored over several European currencies, where tighter fiscal constraints and uncertain spending prospects weigh on the outlook. This bias toward carry and growth-sensitive currencies ties back to the broader risk on tone in parts of equities and credit, but it coexists with pockets of risk aversion, especially in digital assets. Bitcoin and other major cryptocurrencies have just suffered their steepest weekly declines since late 2022, driven by risk-off sentiment, the tech sell-off, and forced liquidations, even as industry and legislative participants grow more optimistic about reaching a compromise on U.S. crypto market structure that could eventually enable greater institutional participation. Commodities, and especially precious metals, are acting as both barometers and shock absorbers for today's macro and geopolitical risks. Gold has just logged its strongest two-day rally since 2020, while silver has bounced 5 to 7% from recent lows, reflecting a mix of safe haven demand and renewed interest in hard assets. Part of this move is linked to growing concerns about the long-term sustainability of major fiat currencies, as investors scrutinize fiscal positions in the United States, Europe, and Japan, and look for alternative stores of value. At the same time, some of the latest buying appears to be speculative and retail-driven, pushing gold and silver to behave more like risk assets at times, which could amplify volatility precisely when investors are relying on them for diversification. In energy, the message from equities differs from that of the underlying commodities. Despite Brent crude having fallen about $20 per barrel from last autumn's highs and forecasts that recent U.S.-Iran tensions may have only limited direct impact on prices, European energy stocks are outperforming, with majors such as Shell, Total Energies, and BP gaining more than 1.5% even on days when oil is flat. That strength reflects resilient refining and marketing results after years of investment in asset upgrades and midstream expansion, as well as policy support for infrastructure projects like new pipelines and expanded refining capacity that could process additional barrels, including potentially more Venezuelan crude if geopolitics allow. The upshot is that energy equities are being driven as much by capital discipline, cash flow, and policy as by spot commodity moves, reinforcing their role as an equity factor rather than a pure oil price proxy. Natural gas and broader supply chains add another layer to the commodity story. European gas storage entered winter at lower levels than last year, in part because negative seasonal price spreads made summer injections less attractive, and refilling those reserves this summer is expected to require sufficiently high prices to attract liquefied natural gas cargoes. Producers such as OMV point to ongoing supply constraints and see gas and chemicals as areas of structural growth, even as the war in Ukraine continues to damage regional energy infrastructure and add to security of supply concerns. Overlaying this are trade and industrial policy tensions, from tariffs that have already reduced container volumes through key U.S. ports and pushed up input costs, to China's use of export controls on rare earths and the European Union's dilemma between strict environmental standards and a rapid build out of domestic critical mineral processing. For real asset allocators, These dynamics support the case for continued attention to energy, infrastructure, and materials exposures as both risk and opportunity in the years ahead. Across assets, the picture is one of rotation and divergence rather than a simple risk-on or risk-off regime. Equities are still supported by healthy earnings and policy tailwinds, but leadership is shifting away from narrow, high-valuation tech and momentum toward quality, value, European markets, and AI-related infrastructure, while software endures a painful reset. Rates and public credit markets remain priced for stability. Even as tensions between fiscal and monetary policy, uncertainty around the Federal Reserve, and pockets of software and bank credit strain argue for close monitoring of liquidity and spreads. In currencies, the debate over the dollar's trajectory and the search for yield in selected high-carry and commodity-linked currencies frame the backdrop for both hedging and regional equity exposures. While crypto's latest drawdown highlights the asset class's sensitivity to risk sentiment despite progress toward clear regulation. Commodities and real assets continue to straddle the line between hedge and risk asset, with gold, silver, energy, and critical materials all responding to concerns about fiscal sustainability, geopolitics, and the energy transition. For allocators, the key is to watch how these moving parts interact. Whether equity dispersion spills further into credit, how central banks manage balance sheets and communication, and how real-world AI adoption and geopolitics feedback into growth and inflation expectations. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.